Hi, and welcome to this AQA A-Level Business revision video focusing on 3.5.2 Analysing Financial Performance. In today's video, we're going to look at budgets and cash flow, similar but different. A reminder that my teaching here is separate from my teaching and consultation roles in any and all schools and academies around the country. My name's Mr. Giles. Let's get down to business. Okay, let's first look at budgets. Now, all I want you to do is think of a budget like a target. So just drop the word budget out of your brain for a second and think of the word target. Now, a business can have a target or a budget for multiple things. And this is where it gets a little bit tricky, because when you and I think budgets, we think this is how much money we have to spend. Can we meet that budget? However, we can have revenue and profit budgets. Okay, so it's a target for the business for costs, revenues, and even sometimes profits. Now, it makes sense for them to have a target for costs and a target for revenues, but the profits one might kind of set you back a little bit. However, businesses, especially PLCs, are held to a high level of account for their profit budgets or their profit targets. So there's a really kind of interesting story. Back in 2012, I want to say it was, that Tesco had budgeted that they were going to make something along the lines of 180 million pounds profit, okay, or maybe a bit more than that. And then about 2/3 of the way into the year, they were miles away from meeting that budget. And unfortunately, that caused their stock price to plummet and for loads of their shareholders to sell their shares. So they do have to put down on paper in hard words how much profit they think they're going to make, because that's usually how investors make their decision. So budget equals target, same thing. Okay, so we've got our budgets, we've got our different targets, wonderful. Well, what does that look like in the real world? Well, let's use a cost budget because it's probably the one we're all used to. If we have a look here, I've got my lovely cost budget, and all I've got is 3 different things to worry about. I've got my wages, my bills, and my stock. Now, here's what's happening. I'm going to budget 300 million for my wages, 100 million for my bills, and 500 million for my stock. That's my budget. So that's the money that I've set aside and will make sure is in the correct places for those things. Now, what we don't want to do is we don't want to reach our budget. We'd like to go under our budget because that means we're saving money. But what we're saying is during this business year, we can go as high as that much money, but really we don't want to go over because that's going to cause us problems. And then we look at what actually happened. So we spent 350 million in wages. So somehow we spent 50 million more in our wages. That might be to do with, say, overtime, could be anything, okay? Could be a sudden increase in inflation, loads of stuff. Okay, but our bills, we only actually spent 75 million. So apparently people were running around turning light switches off, great. And then we only actually spent 425 million on our stock. And there's language we need to use for that. So we were going to spend 300 million, but we actually spent 50 million. So that is what we would consider adverse. That is an adverse variance. Okay? Because that means we were 50 million pounds over our budget. That's why it's adverse. Adverse is another word for bad. Okay? So we had a 50 million adverse variance. Okay? We spent 50 million more than we said we were going to spend. However, these two are favourable because we spent under our budget. So we had 100 million here, but we only actually spent 75 million. So we are 25 million away from our budget. We're 25 million under our target. That's favourable, a 25 million favourable variance. And then down here, again, 425 instead of 500. So we've got a 75 million favourable variance. So if we add them up overall, our budget for all our costs was 900 million, but we only actually spent 850. So we've got a 50 million favourable variance for our cost budget. If a business saw that, they'd be super happy. All right, because then you think, well, hang on, how was they allowed to go over on their wages budget? Well, probably because these ones down here were a bit more favourable. That's a cost budget. So if we go over our costs, it's adverse. If we stay under our cost budget, it is favourable. Where it gets complicated is if you switch this to revenue. So imagine if we had a revenue budget here and we said our target or our budget for revenue was £1 million, and then we only actually made 900,000. okay, that becomes adverse again, doesn't it? Okay, up next we have cash flow. Now, cash flow and budgets are similar but different. As we said, budgets are a target. We're looking to aim for something. Cash flow is more realistic in that it is the physical movement of money, physical money, like your card, your cash, in and out of a business. Now, there's an important distinction that needs to be made here. Profit is retrospective, and I've said this in previous videos. Profit is retrospective. What that means is when we do a profit calculation, which is in the previous video, what we're doing is we're looking back in time at what has happened, and it's merely a calculation. So if you calculate that your business made £1 million profit, but then you opened up your banking app, you're not going to see £1 million in the bank. It's merely just a storytelling device to explain how well that business did over the course of the year. And again, there's more on that in the previous video. Cash flow, on the other hand, is the physical representation of the actual money that's in the business. Cash flow is not profit. Profit is not cash flow. They are very different. They are mutually exclusive. Okay? So profit is just well, how well did my business do as a measure? And then cash flow is what do I physically have in my bank account right now? Okay? Because your business can make £1 million profit and not be able to pay the bills. That's a realistic thing that can happen. All right. So cash flow, the physical money that flows in and out. Now, there's two ways of looking at this. We can look at what is actually happening. So we just open up our bank accounts and we look at the cash flow. What we often get asked to look at is a cash flow forecast. And a forecast is what we think is going to happen in the future. Again, when we're looking at cash flow in the future, we're not looking at profit in the future. We're looking at what physical money we think we're going to have. And if we can identify any areas where we're not going to have enough physical money, we can organize some sort of source of finance to help us out. That's where credit cards and overdrafts come in. Okay. Now, I've made this table here on the board. Do not get married to this structure because they can present it in a myriad of ways. What happens is it's an overall kind of idea that you then have to be able to master and work your way through. So don't get married to the structure, but just get yourself linked to the concepts within it. So I've laid this out literally like what your bank account, your bank statement would look like. And that's how I like to think about it. I like to think about if I open up my bank account right now, this is what I would see. So we have the opening balance at the top. So that's what you started the month with. So if you opened up your bank account and download your bank statement, it would say September 1st, you had this much money. That's your opening balance. That's what you started the month with. You've then got your inflows. So what money went in, what physical money came in, usually comes from places like revenue. What are your outflows? So what physical money did you spend? Where did you spend your card? For you lot, it'd be like Nando's and hopefully WH Smith's buying revision materials, eh? Fingers crossed. But where did the business spend money? And that would be its, its wages, its electricity bill, its stock, its physical, tangible bills. All right. Then we get this thing called net cash flow. And as I've put here, I've put a negative symbol here. Net cash flow is very simply the difference between all the money you had coming in that month and all the money you spent that month. All right. And what I like to think about is this. Imagine I just floated around in the month as my business and I collected all of this physical money. I'm a traveling hairdresser and I collected £100. It's in my pocket. And then throughout the month, I had to buy some accessories and stuff, some hair gel and all that kind of nonsense. So I spent 60 quid of that cash in the shops. At the end of the month, I've got 40 quid just sat in the glove box in my car. All right. What am I going to do with that £40? I'm going to pay it in the bank, aren't I? I don't want to leave cash in my car. That's silly. So at the end of the month, I go and pay it in the bank. Now, what is already in my bank? Well, as it happens, there's already £50 sat in my bank. That's what I started the month with. So I take my 50 quid in the bank. I take my 40 quid that's in my glove box. I wander down to Barclays. I pay it in. And now my closing balance at the end of that month, September the 31st, is £90. So inflows minus outflows makes me my net cash flow. And then net cash flow plus my opening balance gives me my closing balance. Okay, so if you're like, well, where's he got this number from? This was the money that I had floating around in my pocket at the end of the month. This was already in my bank account. I just paid it into my bank account. Now, if my closing balance in September, or sorry, it's January up here, isn't it? Sorry. If my closing balance in January is £90, what's going to be the opening balance in February? So from January 31st, I go to bed, 11:59. I wake up 2 minutes later, 1 minute past midnight on the 1st of February, and I open my banking app, what's in there? Bizarrely, hopefully, still £90 because the money fairies haven't come to rob me. So let's put that in there. Okay, so I've got £90 in my opening balance. Let's imagine we have a very similar month. 60 quid going out, 100 quid going in. I got 40. Okay, I've got £90 in the bank already, and I've got 40 quid net cash flow, £40 of money that I didn't spend. It's in the glove box. Got to pay it in the bank. Wander down to Barclays. How much is in my bank account now? Had 90 at the start of the month, got 40 to pay in. What have I got? I'm sure you're writing it out now. 130. You've got it. If I end February with 130, what's in March? You got it. 130, so on and so forth. You got the idea. Okay. So what I'm predicting is that by March, I'll have £170 in my bank account. Okay. That is called a cash flow surplus. A cash flow surplus. That means I've got more money in my bank account than I need. If I was at zero, that'd be okay. Okay, that's fine. That's nothing. That's just zero. But I've got a surplus of cash. That's really positive. That means if I'm waiting to make a big purchase, let's say I need to buy a new pair of scissors for my hairdressing business, and they're £100, I have the physical cash to do that. That's a good time to do it. Was January a good time to buy a new pair of £100 scissors? No, because I only had £90 surplus. So I'd have to borrow the other 10. So if I'm planning to buy new scissors and I've planned this out, I'm going to buy them either here or I'm going to buy them here when I have a cash flow surplus. Now, should it go the other way and this was negative 90 because we spent more than we had, that would be called a deficit, a cash flow deficit. And what that means is that you're spending more physical cash out of your business than you are receiving into your business. Let's clear the board and we'll discuss that just a little bit further. So we create our cash flow forecast, or we just have a little look at our bank accounts and we realize that we're running either a surplus or a deficit. So a surplus means there's lots of money in my bank account that I'm not currently using and don't plan to use. And a deficit means my bank account's probably in an overdraft, or I probably don't have enough cash flow coming in. So I've got bills coming out in the future that I can't perceive myself being able to pay. So they love in the exam to ask you questions, basically how to solve a deficit. We'll quickly skip over a surplus, but they like asking about how to solve a deficit, or they often say, analyze the financial performance of this business, and then you identify in the cash flow forecast that they're running at a deficit. More on that in a second. So the surplus, if I've got money sat in my bank account that's got no immediate kind of purpose, then these are the opportunities I've got. Number one, I could just buy more assets. So as I said before, I might buy myself a new pair of scissors, or if there's things that need replacing, I can do that. Up next, I might just buy more stock. If I'm running a just in case scenario, and again, there's videos on that, look in the playlist, I might just decide to start buying more stock because it might get me better economies of scale. So although I'm spending my money, I'm getting more stock for cheaper, and that will inevitably improve my profit. Okay, so that might be a good opportunity if I've got surplus cash. Or lastly, I might just be able to reduce some debt. Most businesses are geared up some way, shape or form and owe money somewhere. So this might be a good idea or a good opportunity to reduce some of that debt and reduce the amount of interest that we pay. So that's what I could do with a cash flow surplus. So if you're asked to analyze the performance and you see they're in a surplus, those are your evaluation points. In a deficit, it gets a bit trickier. A deficit means that we are spending money that we don't have. So we need to find some sort of source of finance to help us. And that's that bottom bullet point there, borrow money. If we're running a deficit, it means we're probably either in our overdraft or we're relying on credit cards, or we're going to have to use some other source of finance. Maybe you need to sell assets, sell some shares, this sort of stuff, all right? Now remember, this is your day-to-day running. So things like bank loans ain't the one, folks, because why are you going to the bank to borrow money to pay wages and electricity? They're not going to like that, and they're probably not going to lend you that money. So we have to be careful running at too much of a deficit. It's okay to run your business at a loss, because that's not true, is it? That's just a situation. But running at a deficit is dangerous because you're physically spending money that you don't have. So how do we fix that? Well, there are essentially two ways of doing it. The way it's usually done is via wages. If a business is running a serious cash flow deficit, the first thing they do is make redundancies. Because they're like, look, we just can't afford to pay these wages. Or they swap over to things like 0 hours contracts, stuff like that. So usually it's people who are bled first in organizations because they're usually one of the biggest expenses. The other thing is to go lean in some way, shape, or form. So that might mean you use cheaper quality raw materials to try and bring your raw materials bill down. It may well be you move to a lean production or a just in time production so that you can downsize the size of your factory. It might be that your rent is your biggest expense, and then you might be able to get rid of your stockroom, rent out a smaller premises, and use just in time instead and leverage somebody else's stockroom, i.e., your suppliers. The other way of doing it is be able to maybe increase productivity so you can get more money coming in, and therefore you're trying to be a bit more lean because you're trying to waste less time. So those are how you fix a cash flow deficit. So that's budgets and cash flow. If you have any questions, put them in the comments down below, and I'll catch you in the next one.